Stocks bounced back after yesterday's sell-off as we await election results in Georgia. Today, the S&P 500 was up 0.71%, so a pretty healthy jump there. And we'll see what that means for our posture, in addition to looking at a lot of different macro fluctuations today, including the energy markets, and then also what's going on with interest rates, which will lead into our trade application example. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 5th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, then go down to our description and sign up for our email distribution list. We also have a presence on Twitter. If you're not following me already, I would encourage you to do so. My handle is @BrandonVanZ. And we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And last but not least, we have a presence on Facebook as well. Feel free to join our group at the web address you see in the logo in front of you. All right, well, let's jump into today's market activity. And as you can see, I've got chart 4B pulled up here in front of us, where we can look at all four major U.S. equity indices side by side by side. And it was a pretty healthy advance here today in all of our charts, except for the Russell 2000. Let me just check that because this data seems maybe a little bit stale. Hang on just a second. Yeah, that's odd. For some reason, the rut on my chart here shows a red candle. I'm not sure exactly why that is. Very interesting indeed, because it's not even showing the candle for today. So this red candle, as I hover over it, I can see the date at the bottom says January 4th. For some reason, it doesn't look like the Thinkorswim platform is plotting the candle for today, even though up here in the percentage area it shows that the small cap index was up 1.7%. So it was an extremely strong day for the Russell 2000 here today. So I'm not sure what's going on there, but hopefully Thinkorswim will get that resolved here in the coming days. Nonetheless, as we take a look here at the NASDAQ composite, you can see its candle is plotted here for January 5th, and it was a pretty healthy day as well, up 0.95%. You can also see here that the Dow Jones Industrial Average was a pretty nice 0.55%, and the S&P 500, as I mentioned previously, was up 0.71%. So a lot of this was kind of a bounce back after a very difficult start to things yesterday. And so I wouldn't read too much into it. The reality of the situation is we still did not eclipse the highs that we had set previously. Now, on the same token, we don't want to get too negative here. You can see that the trends remain in place. We are still above a rising moving average. What we're kind of grappling with is the fact that we had such a strong close to 2020 that it is possible that we kind of stumble out of the gate here in 2021 by either giving some back and going a little bit lower or even going sideways. So just like somebody that is sprinting for the finish line, they're going to need to kind of try to catch their breath after they're done. And that's kind of how it felt at the end of 2020. Stocks were sprinting towards that finish line of the year end, and now they're trying to catch their breath at this level. So we'll see where things shake out, but the trends do remain in place. You'll notice the background colors of all of these charts have that dark green shading, telling us that the intermediate posture, so that's the green line here on the market forecast technical indicator, is considered strongly bullish in all four of these cases. Now you will notice that they are kind of starting to fall a little bit within that upper reversal zone. In all of our four cases here, you can see that the green lines in the labels says falling in it. So they're not necessarily going in the right direction, but because they are still at this exact moment in time in that upper reversal zone, we'll still call them bullish. Now take a look here that at the Russell 2000, the green line is at 80.71. That's about as close as you're going to get and still be able to call that bullish. So if we do have a sell-off day again tomorrow on the Russell 2000, it's possible that that comes down kind of below that area. Then again, because of the unique circumstances of Thinkorswim not plotting that candle today, I don't know how that affects things either, because this appears to my eye like it is still based upon yesterday's candle. So with the Russell 2000 up 1.7% today, my suspicion would be once they get that corrected on their system, the green line will likely bounce a little bit there as well, giving you a little bit more leeway. So we'll keep our eye on that story here in the coming days. Let's go ahead and take a look at some other charts now. And by the way, I wanted to point out as well, some of you might have caught this if you attended my Monday top-down trend trading class, but we've got 8 charts that we are using in that top-down trend trading class now. So if you are one of our premium members, make sure you check out that class that I taught there on Monday. We'll have a lot of good stuff for you, including this chart here, which is equal weight versus market cap weight ratio chart, which is one of our new charts that we did not have previously, which will kind of give us a better idea as to whether it's kind of the march of the army, so to speak, or whether it's the generals themselves that are leading the market. The way that you would read these ratio charts here is by looking at the first one in the ratio. So example here, let's do one that's kind of been all over the place here recently. Let's talk about technology in the upper right-hand corner here. This says EW, and that just stands for equal weight. And remember, I've got these labeled up above here in the grids as well. So it just means equal weight technology divided by market cap weight technology. And so the direction of the chart is effectively telling us whether the first symbol is outperforming the second symbol. So the way that you would look at this is over the last 3 months of this chart, equal weight technology is actually outperforming market cap weight technology. But over the last, let's call it month or so, you might not be able to get away with saying that. It kind of peaked out here or topped out on December 10th and has pulled back since then. We got a little bit of a bounce in the last few days, but we are still down from the 10th. So basically the way to think about that is since December 10th, stocks like Apple and Microsoft and the other heavyweights out there are doing a little bit better than the average or typical technology stock. So anyway, we probably won't use the chart a whole lot, but just wanted to make you aware that it is available there just for unique insights and availability, along with a whole bunch of other charts that we've got going on as well, including a brand new main chart that we use for my top-down trend trading class, where we're kind of implementing a new feature called the WAR score, or weighted aggregate returns, to be able to assist us with some of our trade decisions that we make in that trend trading class. So anyway, want to make sure you're aware of that change there in case you didn't catch the news up until this point. Anyway, let's get back on track here with our more traditional review, and let's take a look at maybe the 3 green arrows chart set up on the indices here. And here you can see we actually don't have 3 green arrows at this exact moment in time on any of these charts. Remember, if we do have 3 green arrows on this chart set up for 4D, we would see a background color either green in the case of 3 green arrows or red in the case of 3 red arrows. And right now, the background colors are white on all 4 of our charts. We did recently have 3 green arrows signal for just one single day here on the Dow Jones a couple of sessions ago, but we did lose that momentum there on the MACD and also got a red arrow on the stochastic. So we're kind of meandering right now. We're in no man's land. I would say we're still in an uptrend. It's just that we don't have that oomph, that adrenaline rush that we once did in late 2020. So we'll see if we can kind of rev our engine back up, or if this is a time where we need to kind of be patient and wait for the market to kind of work itself out here going forward. Let's see where things stand right now on the 1040 crossover method. And on these charts here, remember, these are longer term charts. So this is chart 4C, where we're able to look at charts that are 3 years in length in each of these cases, and every one of these candles is 1 week, or it represents a full week, so Monday through Friday, unless of course there's a holiday or something. But you get the idea that it's a little bit of a less sensitive approach towards the markets compared to some of those other charts that I was just looking at on the daily candles. And so this will give us kind of a broader view as to, how are the trends shaping up For the longer term, and right now, naturally, things are pretty bullish. You probably don't need me to tell you that. We've been hitting all-time highs here in recent weeks on most of our indices, and so naturally, the conditions, the trend trading conditions, are considered bullish for most of these longer-term charts. And one thing I will point out is that we've had quite the up move here on the Russell 2000, and it makes you wonder if there's it's due for a little bit of a give back here after such an impressive push there. Notice the difference between the orange line and the blue line. And again, as a reminder, the orange line in this case is the 10-week moving average. The blue line is the 40-week moving average. And you can see that those lines have separated further and further away from each other as the weeks have gone on, ever since giving us the crossover back here the first week of August. That is generally perceived as bullish activity, particularly since the small cap Russell 2000 broke out above all-time highs here that previously was placed here back in 2018. Remember, that made that index a bit different than the others. The others have already been hitting all-time highs. Russell 2000 really just started doing that within the last couple of months. So it was great to see that surge, and it didn't slow down along the way, right? Sometimes on especially individual stock charts, if you approach a resistance area, you start to get market participants to kind of hem and haw and think about whether they want to continue that move or not. And sometimes that resistance is an excuse for the sellers to kind of come on board and kind of overwhelm the buyers. Well, that did not happen with the Russell 2000. Russell 2000 continued to surge despite that horizontal resistance we had back here and sliced right through it like a hot knife through butter. And so that was a good sign that the bulls were serious about it this time, and those of you that would have taken that bet have been handsomely rewarded for that in the last couple of months. Remember, I'll be teaching my factor-based swing trading class tomorrow, and one of the main factors that has been in focus for the last 2 or 3 months in that class has been the small cap or the low size factor. It's been the leading category for the last 2 months at this point and continues to be the case. So we're going to look for more small cap opportunities tomorrow. In fact, I just got an email from one of our clients here a moment ago saying that one of the small cap stocks that I had never heard of before we took a trade on it here a couple of weeks ago actually got a buyout offer here today. So, there's interest not only from traders in small cap companies, but there's also interest in other companies purchasing small cap companies where they see opportunities and values right now. Anyway, let's go ahead and take a peek here at some other charts. And I wanted to show you our 12 grid analysis now, and let's go over here to the asset class 12 grid, and this will be chart 5A. And as you can see here, it's a little bit of a mixed bag between the pinks and the greens. Remember, the green charts will be the ones that currently have a bullish posture using the intermediate line on the market forecast technical indicator. The pink charts will be the ones that have the bearish postures using that same intermediate line. As it stands right now, SPY actually has a pink background, which is kind of interesting because you'll recall that the SPX, the index that it tracks, is still bullish. So this is a rare example where there's a slight disagreement there between the ETF and the index that it's attempting to track. It's not a big difference, and right now, like I try to remind you guys regularly, posture setting is one thing. Actually, trading based upon chart patterns is the second part of that equation. And right now, when we're looking at something like SPY, yes, you could make the claim that we have a weakly bearish posture. Remember, it's not strongly bearish. We've got that lighter shade of pink there on the background. But the fact that it's still above a rising moving average should be worth something in your eyes as well, recognizing that, hey, yeah, you might have a little bit of a give back here, but it is still a trending security, and therefore you're probably not going to want to make big bearish bets either. You're going to kind of want to take a wait and see approach at this exact moment in time. Now you'll see that the other pink charts on the board are the long-term U.S. Treasuries, which we're going to talk about that again later on in the video, but you'll notice that continues to be mired in a downtrend, and today was no exception. Treasuries were down another 0.74%. This one, unlike the SPY chart up above, is considered strongly bearish, not weakly bearish. Notice the darker shade of the pink background color there. You'll also notice the red moving average telling us that price is still below a falling moving average. And you can see that the same thing is happening here with the US dollar. And remember, that's a continuation story of what we've been talking with you about for many months at this point in this presentation. This is not anything new. This is a situation where the US dollar has suffered for quite some time. And that has kind of led into some interesting opportunities depending upon where you are trying to place your bets. A couple of the areas that we tend to focus on if the US dollar is weak is commodities and foreign stocks. And so it should not be a surprise for you to learn that as you turn your attention to the right, when you look at gold and oil, both of those charts are that darker shade of green. And then up here at the top, foreign stocks, whether you're looking at developed or emerging, they both have a darker shade of green background color there as well. So a weak dollar is benefiting foreign stocks, whether you're looking at Europe and Japan, or whether you're looking at China, India, and the like in the emerging space. In fact, the emerging markets really had a shot in the arm here today. They were up 2.4%. Of course, some interesting news headlines coming out about Alibaba's Jack Ma and where he may or may not be at this moment in time. We've also seen some reversal of decisions by the New York Stock Exchange on whether they're going to allow the Chinese telecom stocks to continue to be allowed to trade on the New York Stock Exchange. So there's a lot of interesting storylines taking place in the emerging market space right now. But the fact of the matter is, you look at that chart, and if you're not going to try to politicize the situation, you're looking at that chart and you're saying that's a winning chart. That is a bullish chart. People are making money going into emerging markets stocks. And then the same thing down here with the commodities that I mentioned before. Now, oil, we've already been aware of that, right? This has been a story we've been telling for a couple of months at this point. Gold's a little bit of a different story. Gold was up today another 0.3%, and has been a little bit of a different shaped chart there, as you can see. In fact, right now you still have a little bit of hesitation because despite having a really solid bounce to start the year in 2021, where we find ourselves on the gold chart right now is exactly right back where we topped out here the first week of November. And so it'll be interesting to see if we can get up and through that resistance. We're at this exact moment in time, we have not done that yet, but maybe that will happen as soon as tomorrow. On the other hand, maybe that is a situation where the sellers will come in force and use it as an excuse to pressure that price back lower. So of the two, I think the trend in oil does look much healthier right now than the trend in gold, but the gold chart is starting to turn around. Notice the change in the color of the moving average itself. We had a red moving average for much of this past 3-month period. We have now turned that moving average to solidly green here, telling us that price is now above a rising moving average. So there is a potential trend change afoot here on gold. It's not a guarantee that it will happen, but at least you have the initial makings of that possibility starting to emerge there for us. Now, since commodities were kind of in focus today, I thought another thing that we could do here real quick is take a look at the commodities 12 grid. We don't look at this one quite as often, but when commodities are a little bit more in focus like they were today, maybe it's a good opportunity for us to do so. Now, some of you might have heard the news that Russia and Saudi Arabia were kind of going back and forth with OPEC news, and that kind of sent oil prices higher as they decided to hold off on any production increases here in the near term. And so that helped support oil prices here today. And that, in turn, helps support a lot of commodities. As you can see, this chart in the upper left, and this is chart 5K for those of you that are following along at home, DBC is the chart here that is kind of the commodities index. So this will be this will have inputs from a lot of different types of commodities, but of course oil is one of the most influential ones, so it's going to have kind of an outsized impact on it. And you can see what I'm talking about here. That US dollar falling in recent months has really helped the commodity area kind of be a sneaky bullish area of this market. We talked about a few weeks ago in this presentation how on my sector selector, we started to see some impact from energy, which we hadn't seen for forever, right? It had been 2 years since my Monday top-down trend trading class had owned an energy stock, because we focus on outperforming sectors in that particular class. And then all of a sudden, energy kind of emerged out of nowhere here a month or two ago. And we actually bought an energy stock for the first time. And I noticed that stock was up like 6, 7, 8% today, something like that. But that it wasn't alone. There were a lot of energy stocks that were doing that today. So, all of a sudden it seems like oil and gas might be an interesting place to start kind of sniffing around for value. Remember, those areas have been beat up terribly over the last several years. And so while it seems like they've gone up a lot here in the last couple of days, they still have a lot of ground to make up before they're anywhere near some of the high levels that they had reached years ago. So that'll be an interesting storyline to watch in 2021. What happens to oil and gas and other commodities? As you can see here, a lot of these charts shaping up pretty nicely. Oil itself was up nearly 5% today. Not only that, but the candle is pretty important because we got up and over that prior high that we had set there in the middle of December. And of course, we have that strongly bullish posture in addition to a green moving average, a good setup there. Natural gas was up 3.5% today. That chart looks completely different than oil, but it is now back above its moving average. So we'll see if maybe it's going to use it as an excuse to start bottoming here too. Gasoline is really shooting higher. So, all of you with your SUVs, quick, go out and fill up the gas tank as fast as you can here, because your gasoline prices are probably going to be going up here if this chart is any indication. UGA is the ticker that we are using to kind of gauge that, and you can see gasoline prices, I should say, to be specific, not to be misconstrued with the natural gas. So this is gasoline prices have been really surging here in the last several months. Maybe the market is anticipating that this coronavirus vaccine is going to do its job, and we'll all be out driving around as often as we had in the past, in addition to, of course, the falling US dollar that I mentioned before. There's gold, and you can see that silver looks somewhat similar. Although I would say that of the two, I probably prefer the silver chart a little bit more than gold here. Notice that silver is trading at 3-month highs right now. Gold is not quite there because of that crazy 2-day kind of reversal pattern that we had back here the first week of November. So silver seems to be leading the way from the kind of industrial side of the equation a little bit more. Platinum, that's another great area, as is copper. Take a look at those metals. Again, not a lot of people talking about them, but those are some pretty healthy looking charts there. Strongly bullish postures, rising moving averages, and then we come down to the soft commodities down on the bottom rung here, and look at corn taking off. Corn is up in a big way, up 20% here just in the last 3 months, and a big chunk of that has come ever since having that nice kiss off of that moving average and bounce back up here in the last month or so. And then you can also see that sugar is making a pretty decent move. Cocoa and coffee not doing quite as well there. But on the whole, I would say that this is a pretty promising outlook when you're looking at commodity types of investments. Now, real quick here before we do the rest of our charts, let's pop on over to the internet. I always want to say thank you to those of you that click like for me on Twitter. Remember, that's your way to say thank you to David and I and encourage us to do these videos as often as possible. If you get value out of these videos, that's the only thing we ask out of you, is just simply click like for us there on Twitter. So thank you to all of you that did that for me the last time around. Please do so again if you're getting value out of this presentation. But I did want to also highlight another tool. I was very busy over our holiday break developing tools for our top-down trend trading class. I already mentioned some of those new charts that we had put together, and I also want to give a special thank you to Mike Emerson, who has been a champion for me here, as he has been kind of my think scripting buddy throughout this process. So Mike, if you're listening, really appreciate that. But I also wanted to show you here this new tool that I developed on our website over at marketscholars.com. If you're a premium member, you can access this. If you're not a premium member, unfortunately, it would be off limits to you. But for all of you that are premium members, you can find it a couple of different ways, either by hovering your mouse over the Tools tab and clicking on Stock Selector, or you could just type out the web address marketscholars.com/stock selector. And as you can see, it's a very colorful kind of styled tool here that will hopefully lead you to stronger trades that exist out there. We have a proprietary method of ranking various stocks and entities by their strength. And this will give us an opportunity to kind of highlight those stocks on a regular basis. There are 1,000 stocks that we cover in this particular tool. And you can see some of the highest ranked stocks that are out there, stocks like Jumia, which is a African e-commerce company, and then of course Tesla and Enphase and Fiverr and Penn National and Editas and Peloton and Trupanion, Cleveland Cliffs, Sonova, Pinterest, and the list goes on and on and on. There's obviously a lot of companies that are pretty strong right now, but this will be a quick and easy way for those of you that are premium members to come to our website and say, okay, what are the strongest stocks in our universe right now that we can kind of start to look for trade setups in. You can also see that I've got a variety of different tabs down below, so if you wanted to look at the list on an A through Z basis, you can do that. You can look at all the stocks that were hitting 52-week highs over the previous week. You can look at all the stocks that would be considered growth stocks on this tab down here. And then you can also see what stocks we would consider for my top-down trend trading class in this watch list tab down below, along with what stocks we already own in that class. As you can see, one of them right there in the purple font would be Peloton as just one example. But you know, as you start scrolling lower, you'll start seeing more of those as well. In fact, there's Albemarle right there, one of the strongest stocks in the S&P 500 here today, I might add. And that stock has been really tearing it up for our class here recently. So anyway, that's another place where you can go if you're a premium member to discover which stocks do we currently own in my Monday top-down trend trading class. So wanted to make you aware of that new tool. Hopefully you get some value out of it. I've worked very hard on developing it. Also, over here on the internet, wanted to point out that I taught my dividend growth investing class today. And remember, in that particular class, we start afresh every 6 months. And so today was kind of a special day where we kicked off the new portfolio and added all of our so-called stink bids, which is a reminder that I've been doing this process for a long time. And sometimes it's healthy to have a good idea as to what stocks you consider to be really attractive investments, whether it's dividend or otherwise. I happen to take the dividend approach for that class, of course. And the idea behind the whole stink bid philosophy dates back many years. In fact, for those of you that have been with me long enough, some of you might have actually been in this class at that time, back in August of 2015. All 5 of these trades that we were filled upon were filled based upon the stink bid philosophy. In other words, we put in a low ball order, good till cancel buy order, and we didn't assume we would get filled on any of them. We put them in well before this particular date here in August, but we put them in with the off chance that, hey, if there was a market crash or any sort of market dislocation, that our orders are waiting there in the wings ready to buy stocks. So we kind of do that process every 6 months, and naturally last year would have been a good year as well, where we did have a couple of our stink bid orders get filled as a result of some of the chaos and the coronavirus. So anyway, if you're one of our members, whether you're a plus member or a premium member, you would have access to that dividend growth investing class that I taught here today, and the recording is posted if you're interested in that. And of course, I sent out that information via Telegram for those of you that want to check out those stink bid orders as well. And then David taught his directional option strategy class here today, and then tomorrow I'll be teaching factor-based swing trading in the morning, and David will do his options inventory in the afternoon. So lots of great stuff as we kick off the first week of January for all of our members here once again. All right, let's get back on track with the Thinkorswim platform. And wanted to get into our trade application example here today. And for it, I've kind of discussed it already to a small degree, but I'll bring up, let's just do, how about a swing trading chart on this, and let's pull up chart TLT here. And just wanted to point out that we've done a very similar trade to this already a couple of months ago. It might have been like a month and a half ago, but that trade's already rolled off our books, so it kind of opens up the opportunity for me to take the trade again if I think the trade is still valid. And that trade was to sell a bear call spread on TLT. Now, for those of you that are not familiar with TLT, it's basically just an ETF that tracks the U.S. long bond. And so it's a little bit more interest rate sensitive. And so when interest rates are going up, this particular product here tends to go down, and that's kind of the mode the markets are in right now. Interest rates have been going up recently. Bond prices themselves have been going down, and one way to try to take advantage of that is through TLT, which is one of the most liquid, if not the most liquid, bond ETF out there. It's a pretty good bond ETF to do options trading on if that is what you are hoping to accomplish. And that's in this case, that's what I'm trying to do. So I sent the details out. The trade's already done, as is always the case, and I've sent that out to our premium members via our Telegram alerts app. But the trade that I did was a February 161, 162 bear call spread. So that would put my break even somewhere up in this general vicinity right here that I'm circling. And you can see that if you use those crosshairs and go to the left with them, that basically goes right across this candle right here. So that you can kind of use this as your bogey from a visual perspective. And that candle was on November 20th. So the bet that I'm making with that trade is that this ETF stays below the high of that candle on November 20th. So if you agree with that and you agree that this security will remain in this downtrend below this falling moving average with this bearish near-term posture and easily underperforming the S&P 500 over that period, then that's a trade that you can implement to try to make money off of that situation. Now remember, it's a higher probability trade, meaning that the odds of my success are reasonably high, but it also does not offer a huge amount of upside potential. It's basically a credit spread where I'm taking in credit to begin the trade, and my goal is to make sure that I keep as much of that credit as possible. And how that occurs is by time passing, so you do make money off of time decay, and you just make sure that the security itself doesn't breach your short strike. And so in this case, as long as you think it's going to stay below this candle here until the February expiration, that might be a trade for you to pursue there as well. So again, check out those details there in the Telegram app if you want those. But I figured let's fire off another trade there since it treated us so well the first time around when I did a very similar trade here a couple of months ago. And let's see if we can win a couple times in a row by being bearish on U.S. long-term treasuries. All right, that's what I had for you here today. I hope you enjoyed the presentation. As I mentioned before, make sure you click like for us if you did get value out of it there on Twitter. For those of you that are premium members, particularly all of you original beta members that were with us back in 2018, hopefully you saw David's email here a couple of days ago about renewals and the discount that we have available for you on that. And if you didn't get that email and you need those details, make sure you send us an email at support@marketscholars.com. But until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.